Welcome to This Week in Money. I'm Jim Goddard. Today, Chartworks CEO Ross Clark tells us about the best market rebound since the U.S. election. WolfStreet.com publisher Wolf Richter comments on whether the American markets have solidly recovered or are still at risk of a major correction or worse. He also talks about where interest rates would have to climb to have a negative impact on real estate. Ed Steer from Ed Steer Gold and Silver wades in on where he believes precious metals are heading and how silver could climb like a rocket. Plus, at the end of the show, we'll have company showcase updates from Larry Ray of American Manganese, Cypress Development's Don Huston, and Blind Creek's Brian Fowler. We'll talk to Ross Clark right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, CEO of Chartworks.ca. Welcome back to the show, Ross.
Always good to be with you, Jim.
Well, after semi-panic 2 weeks ago, now people are smiling again when they take a look at their stock portfolios.
Well, let's just hope that they didn't keep their stop losses too tight. You know, when you have a run as exceptional as the one was, I mean, basically coming out of the U.S. election, going for all those months right and through the end of January, you know, and all you're having are 2 to 3%, well, not even 3% corrections, then it just means that inevitably the correction that happens will be more severe, it'll be faster, which is what we ended up seeing. So, you know, at the bottom, I guess we were down, depending upon the index, anywhere between 10 and 12% in that week and a half of the break. And, you know, the catalyst was talked about as being maybe the CPI numbers or the fact that the bond market had broken. But in reality, the market was ready for the correction. And I think, you know, people need to, you know, put everything in perspective. When you have those big runs, just set yourself up emotionally that the corrections are going to happen. And yes, if you gave back 10% off the highs, but you've had a 20% run on the year, that's a natural thing to have happen. So here we are. We've now finished off this week with the best week, and depending upon the index, either in point terms or percentage terms, the best week going back for at least a couple of years. And the stocks that held up the best on the breaks are the ones that have come back the best. You look at the semiconductors, done extremely well there. Apple, Amazon, good recoveries off of these lows. So, you know, I think that the corrective phase we'd always talked about as being maybe a 5 to 7%er became deeper. But when you've been as strong and had as much momentum as this, you don't create a top just in a single fell swoop down. You end up with more of a rolling top. So if this is going to become one, and that's still up in the air, the probability is we're going to make new highs before all of this is finished, and then we'll see what happens the next time we start to come off.
But that was exactly my question. Is this going to be a nice climb and then a huge plunge, or again a minor correction?
Yeah. Well, the first thing we saw coming off the bottom here is that as soon as you've been into what I call capitulation mode, you tested the 200-day moving average, all those things, the first correction back, rally, you're going to look to see how it does once it gets back 50% of the move. And by the end of the week, we were actually back 2/3 of the break. And now it becomes absolutely critical just to watch the support levels as we go up. As long as we're not giving back more than half of the rally that we've now put on in this last week, things are pretty healthy. And the odds are that you're going to go up and at least challenge the highs. And we'll need to see what kind of leadership there is as you move along. I mean, clearly, we've had a rotational market over the last couple of years. It was big on all of the infrastructure plays, the Caterpillars, that type, the Deeres, any of those stocks did exceptionally well right after the election. Then we got into financials for a while. The transports were doing famously, and then they came off. So what you need to see is what's the next sector that comes along and takes hold. It is important that we see that the financials continue to do well, because U.S. banks, with higher interest rates, profit margins start to improve, and we want to make sure that we are seeing that in the stock prices, that these financials do continue to step up and have leadership here.
President Trump says he wants to get his infrastructure program underway. Will that help keep American stocks up? Well,
that's depending upon what they're going to do and where they're getting the money from. If they're looking to raise money and have to do it by borrowing, then the cost of that money, the bond market, is going to be a bit of a deterrent to things there. If this road tax they're talking about, that takes care of a different set of items as far as the infrastructure is concerned and repairing the roads. So it's one sector clearly that you need to keep an eye on. It did have that exceptionally good push in the first month or so after the election. You want to be watching and let the market show us whether it's real or not.
Did the drop on the stock market see a rush to gold?
Yes, there was. Actually, it was a move for a weak U.S. dollar. The U.S. dollar actually went down and retested lows that it had had a couple of weeks ago this week. And in the same time, precious metals had some life. Gold did better than silver. Gold got right back up into the 1360s, where it had been a few weeks earlier, but couldn't finish off the week very well, closing back down around the 1350 level. Silver underperformed on the rally, and the miners, which is the thing that concerns me here, is that the miners did not participate very well at all in this move. And if this was going to be a good concerted move on the upside, you'd expect to see the miners really kicking in, and they should be moving at 2 to 3 times the pace on the upside that the gold is moving. And the first day off the bottom, yes, they had a good run, but it just didn't have any staying power for the second part of the week.
Ross, thanks a lot for the update.
Nice to be with you, Jim.
My guest has been Ross Clark, CEO of Chartworks.ca. Coming up, Wolf Richter, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYP.V, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Glance Technologies owns and operates GlancePay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thank you, Jim. Always a pleasure.
Wolf, the Dow and S&P 500 have pulled back from their highs. Now, what happened at the start of the month with that horrible drop? Was that a correction, or was it the beginning of something worse?
Well, it barely qualified as a correction, just briefly, actually, if you define a correction as a downdraft of 10%. However, beneath the surface, there are all kinds of things happening that now mirror what the Fed has been trying to do. And this is an interesting movement because, the Fed stopped flip-flopping at around the summer of 2016 and started getting very serious about rate hikes. And it has become increasingly hawkish. It is now accelerating its QE unwind. So the speed with which it is shedding the securities on its balance sheet has increased in January as it's supposed to, and it's continuing to increase, so they're sticking to that. There is now discussion of 4 rate hikes this year. While all this is going on, stocks and the corporate bond market has not really reacted to any of this. So on the shorter term, Treasury securities took a beating. Their yields went up with the Fed's rate hikes, and when yields go up with bonds, prices go down. So this is turning into kind of a painful experience for investors in treasuries. However, the 10-year yield, so the T-bill, the T-note, didn't respond until late last year. And now its yield has started to surge too. And that's a big thing for the financial markets because the short-term rates don't really impact that much, but long-term rates impact mortgage rates, they impact corporate bonds, they impact all kinds of things. So it's making money more expensive on the corporate end. And even that really hasn't budged much in terms of the credit markets until just very recently. So, and I think now the stocks are finally reacting to some of these movements about a year behind what the Fed has been trying to do. And the Fed is trying to tighten up financial conditions. It wants yields to go up. It wants asset prices to come down a little. It wants to make borrowing a little bit more expensive and harder to do. It wants to increase risk premiums. And all this usually means that it would entail a decline in stock prices, and that just hasn't happened yet. We had another record in January 26th, I believe, as far as the stock market is concerned. And then the sell-off that came after that was the first major sell-off we've had since early 2016. And it really is just an initial reaction to the changing era. We're now in an era where interest rates and yields are going up, where money is getting more expensive, where central banks around the world are trying to wring out some of the excess liquidity from the markets, and stocks have been very slow to react to that. But now they finally have. And of course, the way stock markets are, they ignore things for a long time, and then suddenly, bam, they react all at once, all together, and then dip buying sits back in, and people, try to buy the lows and try to make a little money. So it has come up quite a bit since then. But I think the magic has been broken, that stocks can only go up, that you can't lose money in the stock market. This whole mindset has been broken now, and we're looking at, I think, a new reality where the stock market is starting to contemplate what is happening in the credit markets, and I think there will continue to be a lot of volatility and reaction, and most likely, I think, with big ups and downs, I think there will be a downward bias in the stock market going forward.
Well, what I'm thinking here, what could happen, and several people have told me it's a distinct possibility. Yes, we saw that dip in the market. Now it's going back up. People are sitting at the sideline patiently wondering, will it continue to go up? When they see it going up for a while, they'll think, oh, everything's okay again. They throw into it just in time to catch the elevator as the cable breaks.
Yeah, that's how it works. That's a good, that's a good analysis. That's how it works, and that's how retail investors, get sucked into the market at the worst possible time. And of course, retail investors earlier this year were all in. I mean, that was the time point when retail investors pile into the market with record enthusiasm, and it was just. That elevator, as you said, was just waiting for the cable to break, and it sure did.
On the charts, gold, silver, and oil had large outside days to the upside on Wednesday. Is this a signal that gold, silver, and oil could break out of their trading ranges and into full-blown bull markets?
It could be. I'm not a big fan of gold and silver right now, simply because and oil is separate. I mean, there's a different dynamic at play in oil, so I'll get to that in a moment. But in terms of gold and silver, precious metals follow timelines that exceed my patience. And they don't go, their bull markets and the bear markets don't last a few months or even a few years. They can last a decade and longer, and on the way up as well as on the way down. We have seen that in the past. I've personally experienced that with silver. That was my first big loss in the 1980s. And when I bought it, 1982 maybe, and, after it had dropped 30% or 40% or something like that, and I thought I was dip buying, and it continued to drop, for another, 10 years or another 15 years actually. And precious metals are that way. You just can't outweight them. And so, I think this and there's no fundamentals there really to support this or to support any other move. It's just how the markets work, with precious metals, or at least have in the past. And I think we're not through yet with a long-term downtrend in both gold and silver. I just don't, this takes a long time to work through. I think for people who own gold and silver, unlike cryptocurrencies and other things, that if you own the metal, you always own it, and that's a good thing to have. In terms of waiting for a bull market, I think, just my personal opinion here, I think people will have to be patient. This is just not happening very quickly in precious metals. It's on the way down as well as on the way up. Once you catch the bull market in precious metals, you may have a very long upright ahead of you, and they're really fun, because they last for so long. And, but on the downside, it's the same thing. In terms of oil, there's a different dynamic at play. Oil is a commodity that's being used. And so if you stop producing it, you're going to run out and the price spikes. And if you overproduce it, you're going to have a little bit too much of it. And then people perceive a glut, and then the price plunges. And, so now in the United States, we have, this year probably we'll have record oil output despite the price that's relatively low. This is now becoming apparent, and it's cutting the price back down. And, so I need to see, oil balance. And we had the oil bust in the United States, as you had in Canada, and in 2016, after the money had dried up in 2015, in 2016, hedge funds and private equity funds started piling back in, and oil companies were able to raise many, many billions of dollars in equity funding and in debt funding. And they have now plowed this money back into production. So oil production in the United States in the shale patch is just surging. And despite the price, it remains relatively low. So I think we're looking at another scenario where overproduction will hit the price pretty hard. I don't see oil turning around seriously until the money stops going into it. And this may happen. I mean, we have the Fed tightening. We have some other things happening in the credit markets. So it could happen that, the money finally stops going back into the shale patch until there's some positive cash flows coming out. And then you'll see oil production go down. But that's a while away. Yeah, this is not going to happen next month. So what we'll see this year, I think, is surging production. We'll see rising inventories. We'll see fears of a glut, and I think this could put downward pressure on oil in the global markets, unless you have Saudi Arabia tie up with some other major producers, and they're able to get global production to significantly decline to. And then if the prices don't go down, the shale producers, they can ramp up production amazingly fast if they get the money to do so. So right now, I don't think there's any will in the United States to cut oil production. And as long as we have the surge in production going on, I don't see a real rally in oil.
Could interest rates spike higher?
Yeah, so the 10-year Treasury yield in the United States has gone from about 1.4% or less than 1.4% in the summer of 2016 to almost 3% now. So more than doubled. It lagged way behind. So shorter-term interest rates have already shot up. And with the 3-month yield, for example, already being at around 1.6%, which is the highest since like 2008, the Fed has been driving up its target range for the federal funds rate very consistently. It may speed that up. So if we think that through for a moment, the Fed, if it raises rates 4 more times this year, will bump up its target range to 2.5% at the upper end by year end. That's short-term federal funds rate. So 2.5%. If right now it's at 1.5%. So if the 10-year Treasury rate is 2 percentage points higher than that, it would be at 4.5%. It's less than 3% now. If the mortgage rates follow that path that they're on right now, they'll be at 6% in the United States by year end. And so that will be a 30-year fixed rate mortgages that you don't really have in Canada. With adjustable rate mortgages obviously being lower, but a 6% 30-year fixed rate mortgage for top tier borrowers will be very high. And the Fed is not finished yet. So I believe that interest rates are heading higher, and on the mortgage side, I think 6% represents about the pain level. That's where I think the housing market is starting to get hit. And yeah, the housing markets move very slowly, so this will take a long time to show up. But at that point, at the current home prices, there are many cities, a lot of people wouldn't be able to afford a mortgage anymore, and you'll see volume go down and eventually prices go down. But that's the Fed's intention. Yeah, that's the plan they're on, and they're trying to take some of the ebullience out of the markets. They're trying to tighten up financial conditions. They're trying to, they're worried about financial stability if asset prices rocket higher, and these assets are used as collateral by lenders, and so it puts lenders at risk when you inflate asset prices too much. So they're looking at this whole package, and I think they've gotten very hawkish, and so rising interest rates until something breaks, until that point, until it becomes clear that something has broken, interest rates will continue to rise.
We'll have more with Wolf Richter next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Wolf Richter, the publisher of wolfstreet.com. He is speaking to us from San Francisco. If interest rates go higher, is money likely to move out of the bond market? And if it does, where would it go?
The bond market is kind of a funny creature. You know, if you bought a 10-year Treasury in the summer of 2016, your yield is about 1.4%. If you sell it today, you're going to lose money on it. If you buy a new Treasury today, a 10-year Treasury note, your yield today for the rest of those 10 years will be 2.9%. And if you wait a little while, you buy one later this year, maybe your yield will be 3.5 or 4% or 4.5%. So there is no rush by anybody to buy bonds, and that's why yields are going up. And they go up a little bit, and that makes bonds more attractive, so a little bit more money comes in and to take advantage of these higher yields. And then rates go up even further and so forth. And so it will, you know, yields will continue to rise. Bonds, which makes bonds more appealing. And for bonds that you don't already own, the bonds in your portfolio take a hit, but the bonds that you want to buy become more appealing because the price goes down and the yield goes up. So that's a more attractive purchase. So higher yields will draw in new buyers, but it will cause pain in the existing portfolios. So when the Treasury rate goes to 4%, even when the Treasury rate goes to 3%, the 10-year Treasury yield at 3%, I think will unleash a lot of buying, and there'll be sort of maybe a short squeeze even, and there'll be a major dip in yields, and 10-year Treasuries will probably surge for a little while until that reverses and the trend continues with higher yields and lower bond prices. A 10-year Treasury that yields 4% is a very attractive instrument. So if it gets there later this year, every Treasury that had been bought before, every 10-year note that's been bought before becomes very unattractive and a painful item in your portfolio, but the new ones that are out there that you can buy with a 4% yield later this year will be very attractive. So, I mean, this is how the bond market reacts. When yields go up, your existing portfolio takes a lot of pain, but the new bonds that you could buy look more attractive. So there will be, money will continue to flow into the bond market, but portfolios will decline in value and prices will go down, and there will be a lot of pain and losses. Now, with a good bond where there's very little credit risk, such as a United States Treasury, you don't you can always outweight it. You get paid face value if you bond, but on a 10-year Treasury, you might have 8 years left with a yield of 1.4%, and that's a terrible deal. So for the next 8 years, you get 1.4%, whereas everybody else in the market will get 3, 4, 5, or higher on their equivalent Treasury bonds that they bought later. So I mean that's what the bond market is looking at. The existing portfolios will hurt. The new bonds that are being sold with higher yields are very appealing, and they will be more appealing.
Wolf, are there real estate bubbles forming or popping in Canada and the U.S.?
Yeah, the Canadian real estate bubbles are fascinating to watch because you guys in Canada never went through the housing bust that we went through in the United States during the financial crisis. So your real estate prices, especially in Vancouver and Toronto, just kept on rising, and so the bubbles in those two metro areas are just fantastic. We have some cities in the United States with similar bubbles, including where I live in San Francisco and the whole Bay Area, and New York and some other coastal cities. And so these are very visible large bubbles. In San Francisco, the median home prices are now around $1.4 million US dollars. And a lot of times in San Francisco, a median home is a 2-bedroom condo, maybe with a garage, maybe not, so it's nothing fancy, and people have to pay $1.4 million to get that, which is ludicrous. Those people don't make that kind of, the median income in San Francisco doesn't allow you to buy a median home, and that's the problem the market has run into. And so now interest rates are going up. They're going up in Canada slowly. They're going up faster and further in the United States. Of course, they were never quite as low in Canada, so as they were in the United States. Also, your mortgages are structured differently. Most of the mortgages in Canada are adjustable rate mortgages, so some of them may adjust 5 years from when they're signed, or others may adjust immediately. So existing home owners in Canada sooner or later feel the bite of rising interest rates. And that's a particular problem that Canada has, that the United States doesn't have to that extent, because most of our mortgages are fixed rate mortgages where the rate doesn't change during the life of the mortgage. So if you have a 30-year fixed rate mortgage and your rate is 4%, it will stay 4% for the next 30 years until it's paid off. And so existing homeowners may not be impacted by the rising interest rates until they have to move and they're trying to sell the home, and they discover that potential buyers for this home cannot afford the price that you want because they're paying a much higher interest rate. And so this causes problems in the United States that are structurally different than in Canada. So existing homeowners in the United States are not at risk, but in Canada that's not the case. In Canada, when rates go up, existing homeowners are at risk of default, and that's why you have the stress test now, and you have other macroprudential policies in place trying to prevent this from becoming a bigger problem. I have not seen bubbles pop yet, in the sense that there's a decline. I've seen some slowdowns. There's some slowdowns in Toronto, in some sections, and some price slowdowns in Vancouver too. Condos in Vancouver are really hot still. In the United States, by city, we have seen some price spikes in San Francisco recently, in the Bay Area overall, after some slowdowns last year. So at this point, the higher mortgage rates that we're now seeing, it just started really a month ago, or a month and a half ago, that we've seen the mortgage rate rise in the United States, and they haven't really had any impact on the housing market yet. So I think this will require some patience. We might not really see any major impact from those higher mortgage rates here in the United States until later this year or early next year. You see, it really takes very long for the housing market to react to anything. And, it takes a house sits on the market for a while, then it gets bought, and then it takes 2 to 3 months to close. And, so everything stretches out over many, many months. It's not like the stock market that just pops up and down like this on a daily basis. But it's overpriced, as many of these housing markets are. I cannot imagine that prices will be even level 2 or 3 years from now, given what's happening to mortgage rates.
Well, I think earlier you said you think a 6% or higher interest rate on mortgages is kind of the breaking point. Do you think we'll ever get the way it was in the 80s when mortgage rates were near 20%, and of course real estate markets crashed? Again, is there a magic number here where you can say, oh my God, this is it?
Yeah, it really depends on inflation. If you suddenly have a spike of inflation like we had in the 80s, late 70s, 80s, where we have double-digit inflation, I think all bets are off. This will be a fiasco of an unprecedented kind, I think, in many ways. I don't see that happening. I don't see inflation spike this much. I know central banks are now somewhat vigilant. Because they don't want to, given the asset prices that we have, they don't want to see a double-digit inflation, which could wipe out the purchasing power of these asset prices very fast, and it could cause all sorts of problems. So I don't see that 1980 scenario being repeated here, but I do see mortgage rates in the United States, 30-year fixed-rate mortgage rates of 6 or 7%, or maybe even higher. Possibly, I think that will be over the pain threshold, and it will impact the market. In Canada, you don't even have to go that far. If your adjustable rate mortgages get a rate increase of 3 percentage points, I think many of the more recent home buyers are going to be in deep trouble. And the housing bust doesn't happen because the average homeowner can't make the payment. The housing bust happens because the most vulnerable 10% of the homeowners or the borrowers can't meet the mortgage payments for whatever reason, or rates go up, or they lost their job, or whatever. And 10% is what happened in the United States. We had a default rate on mortgages of about 10%. And so you're not really worried about the top 50%. You're not worried about the people that have no mortgage debt on their homes, or that have a lot of equity in their homes. Nothing's ever going to happen to them. They'll be fine, no matter what home prices are doing. What you're worried about is the vulnerable bottom 20%, and their financial fragility is such that anything that changes in their lives can cause them to default. And when a mortgage payment goes up by $100 or $200 a month, or by $300 a month, suddenly it becomes very difficult to make that payment. And if it goes up by $400 a month, it may be way out of reach, and they will have to default. So, that's what you have to worry about. The averages conceal that. If you look at the national averages in Canada and in the United States, you don't really see the fragility that is happening at the bottom 20% of the borrowers, and that's where housing busts are happening. So I think that's where the damage will be. I don't envision 20% rates. It could happen. I'm not saying it can't happen, but that would be such a fiasco, I can't even imagine what that will be like. But I think 6, 7, 8%, that will be tough enough.
Wolf, what percentage of people buy vehicles outright with cash?
About a third of the people pay cash for their vehicles. That's new and used vehicles, and about 2/3 finance. And on the used car side, there's a lot of cash transactions at the lower end. On the new car side, cash transactions are somewhere around 10-12%, and there are more financing options available on new cars. The leases and the interest rates are lower. So in terms of new car purchases, the new car market is much more dependent on financing than the used car market.
Wolf, how will rising interest rates affect auto sales?
Well, they're not going to help. For now, auto loans are still relatively cheap. They're still getting quoted for new vehicles around 3%, some of them. But they are rising, and new vehicle prices have come up a lot in recent years, so it's getting more expensive to finance them. And so this combination of higher rates and higher vehicle prices is going to make the monthly payments significantly higher. And people have options. They can step down to a used model, or if they're already a used car buyer, they can step down to an older vehicle. And there's substitution available. But on the new car side, substitution gets very difficult at some point, because even the cheaper new vehicles that you want to buy are fairly expensive. And if you want an SUV, there are not even that many used SUVs on the market, especially the compact SUVs, the crossovers. They're a fairly new phenomenon. And they're just now, in the last 3 years, they arrived in large numbers. So there are not that many on the used car market. So there'll be some people will get squeezed. And so I expect higher interest rates to have a negative impact on new car sales, and they may have a somewhat positive impact on the lower end of the used car market.
How are retail sales so far in 2018?
In January, and you've probably seen the headlines, because that was an interesting phenomenon. The headline said that retail sales in the U.S. in January slumped or declined, quote unquote. And what they did is they compared seasonally adjusted sales figures from December to seasonally adjusted sales figures in January, and they did decline. And I think there was something wrong with the seasonal adjustments this time. And the raw sales figures always plunge from December to January. December is the peak holiday selling season, and January is the peak merchandise return season. So the difference is about 20%. So retail sales in not seasonally adjusted from December to January plunge around 20% every year, and they dropped 9% this year. So that was right in the ballpark. But if you look at not seasonally adjusted sales in January compared to January a year ago, they were actually up 5.1%. That's very strong. And if you take restaurants and bar sales out of it, which there's been a problem especially in chain restaurants, going through some kind of recession the last year or two. And so restaurant sales, food services sales, which is what that is called, have been weak. And you take that out of the retail sales numbers, and you get a year-over-year sales increase in January of 5.6%. And that doesn't account for inflation, but it's very strong. So retail sales in the United States are very solid in January after a very solid holiday period. That said, the increase is probably mostly taking place in online sales. I think that brick and mortar sales have stagnated or declined over the holiday period. Online sales, we don't have the exact numbers yet for the fourth quarter, but we have some preliminary estimates, and they indicated that online sales surged by about 18% over the holiday period. And that's huge. That 18% would be one of the fastest increases we've had in the last 10 years. So I think retail sales in the United States are strong. Brick and mortar retail sales are weak, but online retail is just absolutely booming.
Are Canadians and Americans drowning in debt, and are these people likely to ever be debt-free?
Yeah, so we go back to our theme that you don't have to worry about the top 50 or 60 or 80%, and you worry about the most fragile 20 or 30%, and there you find enormous debt levels, both in Canada and in the United States. There's a lot of Americans today that have paid off the mortgages, or they have large amounts of equity in their homes, and that's not a problem. And many Americans are completely out of debt. They pay off the credit cards every month, and they're just fine. But there are 20 or 30%, 40%, that are really struggling with debt, that have trouble making minimum payments on the credit cards. Those that own homes have trouble making the mortgage payments. They're really strung out. Auto loans are a really big thing right now in the United States. That's ballooned to over $1 trillion. Student loans for the younger generation, they're now up at $1.5 trillion. That is a phenomenon you don't have in Canada. But in the United States, we're bankrupting an entire generation with these universities that are so incredibly expensive, and the cost of living that are very expensive for students, and they borrow money to do this, and they graduate with tens of thousands, and in some cases with hundreds of thousands of dollars in debt. And in Canada, the heaviest burden comes from mortgage debt. In the United States, that's less of an issue, but that's a huge issue in Canada. And especially with the bottom, like we said, 30% or so, 40%, I think they're very exposed to their mortgages. And for a lot of these people, I don't think there is any, I don't have any illusions of ever being out of debt. On the other hand, there's 60 to 70% of the people that have very little or no debt, and they'll be fine. The crisis always hits the most vulnerable, and both in Canada and in the United States, there's a huge amount of debt in that sector of the population.
President Trump is for America first and fair trade. Will this affect China's economy?
China and the United States are, whether we like it or not, joined at the hip, trade-wise. We can't, in the United States, we can't do business anymore without imports from China. Last year, the United States imported over $500 billion worth of merchandise from China. And we're talking about electronics, we're talking about components for the auto industry, chips, things that go into our defense products, even though they're trying to keep that under control, but that's really hard to do. And Chinese components go into absolutely everything. And you can't manufacture anything in the United States without Chinese components. That's a relationship, that's a mutually dependent relationship. The United States economy cannot survive without the Chinese economy. And given how dependent the Chinese economy is on exports to the U.S. economy, the Chinese economy can't do without that either. So I think there will be, if somebody tried to cut trade between the two countries completely, it will be a global fiasco of previously unknown proportions, because both economies would essentially crash. And so that's not going to happen, and Trump policies are not going to go that far. I do see some efforts to put some tariffs on Chinese products. The problem really with China is reciprocity. The Chinese companies can do all kinds of things in the United States that U.S. companies cannot do in China. And Chinese companies have access to U.S. consumers and companies in a way that American companies do not have access to in China. And so, if you can establish more of a level playing field between both countries with reciprocity in China, where an American company can open a big plant in China without having to have a local partner, without technology transfer that's not required, with all these things that the Chinese government has put in place, to advance its own causes. If you could get that far, that would be a big improvement for the trade relationship, and it might overall help the Chinese economy down the road. But initially, I think it will be the Chinese economy is really dependent on exports to the United States. That $500 billion, if you took that, if you whittled it down even just a little bit, it would be a big hit for the Chinese economy. At the same time, the Chinese authorities know that it's very difficult to maintain this sort of incredible trade imbalance. Our trade deficit with China last year was like $360 billion. It's been ballooning every year. And, last year was the first year that Trump was in office, and the trade deficit with China just got a heck of a lot worse than it was before. So these announced preferences of a trade policy really haven't been converted into any kind of actual results. There's some discussion of tariffs, and there's some incentive policies that have changed and so forth, but it really hasn't had a lot of impact. A big part of the problem is that American corporations are actually driving a lot of this trade deficit with China. That goes from Walmart, which sources much of its merchandise in China and other places in Asia, to corporations like automakers that get the components from China and now already getting their cars like the Buick Envision and other models that are assembled in China. So, it's driven by American corporations, and unless Trump wants to crack down on these corporations, they're going to continue to look for places where they can get their stuff, cheaper, and that's the case in China. They're in Mexico too. They're, as long as the American corporations are able to import from those countries where the supply chains produce results. They're going to do that, and unless Trump cracks down on it. So I don't think that the trade policies at this point have had any impact. I mean, there's been a lot of rhetoric, but I just have not seen that in the numbers, and and it would really have to, any significant change would have to come from American corporations, and that's not happening. They're fighting against it. They're resisting Trump on this, and so this is really, and tariffs aren't going to change that much. There's tariffs on solar panels or whatever. It's just tweaking things at the margin, and it's making things more expensive in the United States. And they've picked solar panels because that goes against the philosophies of the Republican Party apparently. But it's not going to have any major impact on the trade deficit with China. What really needs to happen is a policy that encourages American corporations to change their supply chains.
What are your latest thoughts on Bitcoin?
Bitcoin is a form of online gambling that is not regulated in the United States and in many other countries. In the United States, online gambling is highly regulated, and much of it is illegal. Bitcoin trading is not illegal. There's 1,500 other cryptocurrencies out there now. They're ballooning. There's new ones all the time. They're really not usable currencies in any way. People use them for speculative purposes, trying to make some money, and in terms of just betting on it, and that's gambling, and that's what it has boiled down to. In terms of the entities that issue cryptocurrencies, I mean, they collect a lot of real money for that, and so there's a big wealth transfer going on that end. Some of these activities have now been stopped in the United States, but this is a global thing. So you can do it in some other countries, and Americans can still participate in it via international financing mechanisms. So I don't see any future for Bitcoin or any of the cryptocurrencies as a currency. I don't know how long they will be around in terms of a form of online gambling. People like betting on them. It's a quick way to make a lot of money and to lose a lot of money, and that's what defines that space. As long as this enthusiasm for this type of speculation continues, I think Bitcoin will continue to, and its fellow cryptocurrencies continue to be around. But it's just there is really no need for cryptocurrency, because we have 180 currencies in the world already. We have a need for money transfers of some sort, and they're already being electronic money transfers have already been made very sophisticated in places like Africa and Somaliland and Kenya and other places. You have been able to buy from a street vendor via your cell phone for years. They don't really have bank accounts down there, but through the cell phone infrastructure, they have established a way of a payment system that's very functional. It's standard practice now in China as well. Bitcoin and any of the other cryptocurrencies are not even in contention for this. This is just standard peer-to-peer payment systems that use the existing currencies, and so cryptocurrencies have not been able to muster into this space at all. It's a very complex, cumbersome, and expensive process to do a transaction in Bitcoin, and it just can't compete with regular electronic transactions. I mean, even PayPal, which is not the best and is very expensive, beats the price of a Bitcoin transaction most of the time. So it's just not suitable for that. However, it is a great way to speculate for people who like to do that, and it has cost people a lot of money recently because all these currencies have plunged in value. and it continues to cost people money, and it continues to make some other people money. So, as long as this continues, I think we'll continue to have these cryptocurrencies out there as a form of online gambling. That's really all it is.
Wolf, how can people find out more about Wolf Street?
wolfstreet.com. Everything is free. We have a good, vibrant commenter community. So wolfstreet.com. Come on by.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, founder of wolfstreet.com. He was speaking to us from San Francisco. Coming up, Ed Steer next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMY.Resources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Ed Steer, founder of EdSteerGoldandSilver.com. He's also director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Edmonton. Welcome back to the show, Ed.
Thanks for having me on again.
Gold and silver. What kind of action are we seeing there, and is that action likely to continue, and will it be bullish?
Well, I'll tell you, we certainly had that interesting day on Wednesday when the CPI report came out. First of all, there was a huge plunge in the price and volume spiked to the moon, and then it rallied pretty well for the next 2 or 3 hours, and it leveled off, and it looked like that things might be game on, but there was absolutely no follow through in the Far East markets on their Thursday, and there's been nothing since. As a matter of fact, gold and silver down today, and I'm sure that won't stay that way, but it's hard to read anything into one day's activity, but it certainly was an interesting day on Wednesday, and gold and silver for the week were both up, so we'll just have to see how things shake out next week.
Is the U.S. dollar key to a strong bull market in gold and silver?
Well, that's what they say. There's certainly no question there is a correlation there, but the correlation it hasn't been all that strong, although I can tell you right now that the dollar index is certainly falling faster than the gold prices going up right now. And I think the dollar has a long way to fall, and I think that this bull market in gold has got a long way to go as well. But the key to the precious metal prices is what I've stated before, and which we'll get into in a minute, is the COMEX positioning the futures positioning in the COMEX futures market. That's where the price is really set, regardless of what any of the outside factors are, including the U.S. dollar.
Do you have bull market launch points for gold and silver?
No, they can start any time. I know that Jim Richter said it started last year or the year before, and we're just sort of monkeying around the bottom here now. But I can tell you right now that if you look at the chart from a long-term perspective, there's no question that we are well into the next leg of a bull market up, and it's just a matter of seeing how it unfolds from here. It's difficult when you look at the markets on a day-to-day basis to draw any conclusion. It's only when you look at things over the longer term. But I would say that the bull market's on its way, but as to having a launch point, not really. Wednesday was a very interesting day, but like I said, ask me that in 2 or 3 months, and I'll let you know how I think about it.
How is the gold-silver ratio looking?
Well, it's the highest it's been for, years and years and years, decade maybe. Right now it's blown out to 80 ounces of silver for 1 ounce of gold, and that's a historically ridiculous high price, or a high ratio. And what it means is, as Ted Butler has pointed out, is that basically silver is ridiculously underpriced to gold, and if you're going to be buying any precious metal, silver is what you should be buying, and the ratio certainly proves that. Because just look at it, silver and gold come out of the ground a ratio, 16 to 1? And even on that price ratio alone, you're looking at a price 5 times what it is today. So 5 times 17 is, $85. And even if it was only half that, it would be $45. So the ratio is absolutely ridiculous. And when it reverts into anything close to being normal, we're going to see gold and silver price that, frankly, you're not going to believe.
Are increasing interest rates good for gold and silver?
In this environment with debt as far as the eye can see coming out of the United States, it's my opinion interest rates are going to make no difference at all. They're so low right now that your return on your investment versus inflation, with inflation rearing its ugly head once again, any interest rate increase has already been gobbled up by inflation, and it matters not whether interest rates are rising or falling in this environment. I think the gold price and the precious metals are going to still power higher from here.
What's the latest on silver price manipulation?
Well, it's been ongoing for, a couple of decades now, and I follow the work of silver analyst Ted Butler very closely, and what we have here is we have a case where J.P. Morgan is almost the largest short on the COMEX futures market in silver. A year ago, Scotiabank was in number 2 place, but they've since exited stage left, and they're no longer a player in the market. And when J.P. Morgan decides they have enough physical silver, or the price is right, or they're ordered to step aside, then it will be over. But until they decide, until that day happens, nothing is going to change from what you see out there right now.
Does that mean the average person should be investing in silver, waiting for that big jump?
Oh, absolutely. This is a time where you'd rather be 3 days or 3 months or even 3 years early than 3 days late, because once this thing goes, as Ted said, it's going to go violently, and there will be no entry point for you. So my advice to anybody is, if you're not in this market, to stick your toe in it now, because when the day comes that it's all over, it'll be too late.
Could silver go for a cryptocurrency-like run?
Certainly, absolutely. I mean, take a look at what happened in the cryptocurrency markets. I don't follow them that closely, but I know a parabolic spike in price when I see one. And silver and gold and any commodity could do that. You just have to take a look at, say, palladium right now, which is in a supply-demand deficit, and you watch the price of that thing go. So, there's not very much silver in the world, and everybody knows how to spell it, and there's a name for it in every language, and it's been money for all of human history. And I can guarantee you that once silver goes, it'll make the currency run in cryptocurrency look mild by comparison.
Now, I think I saw a cryptocurrency that was actually a play on gold. Could there be a cryptocurrency silver as well, or should there be one?
I will tell you what, I'm not qualified to talk about this, but, if they had a cryptocurrency that was, I think Australia's talking about one, and another country's talking about another, where they're going to be able to trade the metals using cryptocurrencies, or they're going to back them or something like that. That's in its very infancy. And it sounds like a good idea to me, but that's still a ways down the road yet.
Is gold still being manipulated?
Oh, absolutely. I mean, gold's being manipulated in silver. Platinum and palladium, not so much. There is some market management in platinum at the moment, but palladium has basically been doing its own thing. But, the two monetary metals, the ones that people watch the most, particularly gold, are heavily managed and have been that way for a couple of generations now.
How are the commitment of traders numbers looking for gold and silver?
Well, let's see. The new one comes out in an hour and 20 minutes, but based on last week's report and how things look like they're going to improve over the week, I would think that we'll see an improvement in gold. the commitment of traders report in silver is already wildly bullish, and the only thing holding it back, the things back, is the fact that gold still hasn't broken through its, or they haven't driven gold below its 50 and 200-day moving averages, and that's a sort of Damocles hanging over the precious metals market, because if J.P. Morgan and the rest of the commercial traders can drive the price down below that mark, then we're going to see lower prices in silver and gold and a much better market structure for gold and the commitment of traders. But right now, as I said, as of this report that's coming out today, it will be still neutral to bearish in gold and wildly bullish in silver, which is a real dichotomy.
Are junior gold and silver stocks heating up?
Well, when we have good days in the prices, there's certainly no question there's lots of activity in the stock, and you can see some of these junior mining companies, which I own a lot of shares in, by the way, so I have a vested interest in this. They can jump like 5, 6, 7, 8, 9, 10% in a single trading session. And once this bull market in silver and gold really get going, then we're going to see just tons of money pour into this market. And as Doug Casey said 10 or 15 years ago, it'll be like trying to get the entire contents of Hoover Dam through a fire hose. It's just going to be the biggest bull market you ever saw. We're going to see moves in those stock prices that you frankly can't believe. But the bull market has started, but it's in fits and starts depending on what the gold price is doing.
Is the Canadian dollar likely to end up in a bull market alongside gold and silver?
Well, that is a good question, isn't it? Now, Canada is a commodity-producing country like Australia or Russia or lots of countries are basically hewers of wood and drawers of water for the Western economy. So I think any currency that has a good gold backing or produces a lot of precious metals like Australia and Canada and Russia, they'll do extremely well vis-a-vis the U.S. dollar, but the best currency of all during this phase will be the precious metals themselves.
What's new with the Gold Antitrust Action Committee?
Well, it's still the same old stuff. Bill Murphy and I were in Vancouver speaking at the Vancouver Resource Investment Conference in January, and I know Chris is off to Singapore and Hong Kong, I think, next month to speak at two or three gold conferences there. And, we're doing various things on the internet through interviews such as yourself, and just getting the word out there. But let's face facts here. Just about everybody and his dog out there, whether it be an investor or a mining company, knows perfectly well that that J.P. Morgan and a bunch of other bullion banks in the U.S. are managing the price through the COMEX futures market. So more and more we're preaching to the choir. It's just the fact that they don't want to admit it and aren't prepared to do anything about it, which is most unfortunate.
Have you guys ever filed a formal complaint?
Well, we've sent lots of stuff off to the CFTC and to the Securities and Exchange Commission and to J.P. Morgan itself, as far as I know. And there's been lots of lawsuits by separate parties against various banks for rigging the precious metals prices, but so far nothing has come of it because the fact of the matter is that if they want to make an impact, they have to go to ground zero of the precious metals market price manipulation, and that's the CME group and the COMEX futures market. That's where the action is, and so far they're just going after the banks and the fixes in London, which is very ineffective. But there's lots of stuff going on out there. Everybody's heard about the lawsuits that the banks have been facing.
Ed, how can people find out more about Ed Steer Gold and Silver?
Well, you just have to Google my name, Ed Steer, S-T-E-E-R. It's edsteergoldsilver.com. And they can check on my website and look at the free newsletter I do provide, or the sample I provide, and they can see whether what I have there is of interest to them or not.
Ed, thank you so much for being on This Week in Money.
And thank you for having me.
My guest has been Ed Steer, founder of edsteergoldandsilver.com. He's also a director of GATA, the Gold Antitrust Action Committee. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Wolf Richter, and Ed Steer. And thank you for listening. Plus, at the end of the show, we'll have company showcase updates with Larry Ray of American Manganese, Cypress Development President Don Huston, and Blind Creek's Brian Fowler. If you have any questions for the show, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, President and CEO of American Manganese. Welcome back to the show, Larry.
Well, it's always good to be on the show, Jim.
Well, once again, your little company has been mentioned in Bloomberg. Can you tell us all about it?
Yeah, Bloomberg, I guess we're interviewing Samsung about Samsung's move into recycling batteries so that they could, secure a source of metals, cathode metals, especially cobalt. And then during the interview, Samsung mentioned American Manganese and Umicore as being two of the recycling companies out there. They didn't say they had a deal with us or anything like that, but just them mentioning us, Jim, is a real catalyst for the other battery companies to become aware that we are out there and that we are doing things. And so this should resonate well with our shareholders and certainly resonates with the management. The Samsung is, as you know, has had problems with fires in their batteries and everything else over the years, and they're looking at shortages of cobalt could affect their business, their battery business, and they want to do something about it. Here we are sitting there, and we say we can get 100%. We don't say that. That's the research firm that does the work for us, CYP.V, that says that. And I keep getting those questions, and everybody has to remember that CYP.V is arm's length to the company, that what they do is independent. We have no influence on their test work and their bench scale work and all of their chemistries that they do to show that our process works. We don't even have anybody in the room when these tests are going on. So, you can take that to the bank. CYP.V would not say, give us a report. They're getting 100% of all the cathode materials they're testing, which is cobalt, lithium, nickel, manganese, and aluminum, if they were not getting that. And we're starting to get some real recognition out there for what we're doing, and that's a start. Sooner or later, and very soon, I think, there's going to be a partner, and it's going to take another event in the cobalt market, and it's probably going to be the event where, and I've said this before, where you see some battery manufacturers shutting down lines because they don't have material, the cathode material, especially cobalt, or shutting down for periods of time for 2 weeks to 6 weeks while they await delivery of the cathode material. And that's going to affect the EV cars, that's going to affect the phones, it's going to affect everything. And I look back and I see in my emails I get queries from companies that do not have any cobalt use for in the EV or the battery manufacturing area. Yet they do have a requirement for cobalt, and they're asking us if we can supply them with cobalt. So that concern is going right across the board, and it's an exciting time for the company. I'll admit that. It's a dismal time for the manufacturers of batteries, and eventually the products at the end, which will be the handheld phones or EV cars. It's going to affect them all. It's going to affect companies that use it for pigments or in glass production or other things, especially metals for cobalt. It's going to affect everybody, and really there's going to be substitution. But it's like I've seen substitution in the past. I've been involved in companies where the metals have been substituted out, and it's usually an inferior product, but it's cheaper. And I don't think people want that. People want a superior product, and they want something that's dependable. So cobalt is not on its way out. It's going to be reduced in the where it goes into the battery, and I've said this before. But overall, as far as we're concerned, there's still going to end up being a shortage, and we're there to capitalize on that. I wanted to mention, Jim, is that we closed the first tranche of the placement. We'll probably close the next tranche next week, and we should have the all the money we need to get through to the exercise of warrants, and we can move on with the project. I'll be announcing next week that we've signed the contract with Cometco, approved it, and that they will be commencing to work on the entire project, which is the 3 IPs and the pilot plant.
Larry, for new listeners, can you give us a bit of a background of American Manganese and what you're up to?
American Manganese is a critical metals company that's focused on the recycling of lithium-ion batteries. Now, we do have mining projects. We have one that's going active this year, and it's on a cobalt exploration where we had high-grade cobalt that was shipped off the property. And we have an Australian company, Longford, that is going to be spending money on it over the next 4 years, and there should be news coming off of that, and who knows what could happen. And we are at advanced stage in our recycling technology. We're going to be doing our pilot plant. We're looking at a commercial plant shortly thereafter, and I will be divulging locations on where that plant may go in the future. Probably not for 2 or 3 weeks, but it's all exciting, Jim. It's just a very exciting time, and I expect that shortly that we will be hearing more and more and more from battery manufacturers than we have in the past.
Larry, where are you traded and under what symbols?
We're traded on the Toronto Stock Exchange Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt, Germany under the symbol 2AM, and you can reach us at our website, AmericanManganeseInc.com, or you can phone the office, 778-574-4444, or you can email me direct at LREAUGH@AMYMN.com.
Larry, thanks for the update. I've been chatting with Larry Reaugh, President and CEO of American Manganese. I'm Jim Goddard. We were talking on February 16th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Don Huston. He's the chairman and president of Cypress Development Corp.com. Welcome back to the show, Don.
Thanks, Jim. Appreciate that.
You have something brand new to tell us here in the media.
Yes, just an update for the listeners and the shareholders on our company, Lithium company, Cypress Development Corp. We've just put out another news release here this morning, and I thought I would just bring everybody up to date as to where we're at.
And where are you at?
Let me go forward with it, Jim.
Yep.
We've just started again a diamond drilling program on our lithium project in central Nevada. We've been drilling there for the last year, 2017. We're now first quarter of 2018. We've started another drill program. It is in progress now. First hole being completed today, and we're very, very pleased with what we're doing. I mean, the reason to continue on with this drilling is the results from 2017 were, in our estimation, were very, very good, and just showed some true value to the property, to the lithium, with the assays that we've received, and we've decided to continue on drilling, and it just is the right thing to do. We'll be doing exploration, step-out drilling, as well as infill drilling right at this time. Now, and that is ongoing. Now, as an aside here, another point that's been added to this news release is the company has, as of the beginning of February, hired an independent consulting firm called Global Resource Engineers out of Denver, Colorado, and they've been engaged to prepare a resource estimate and an accompanying technical report on the 2017 and ongoing 2018 drill results. This is not necessarily overdue, but it is necessary, and it sure should show the investor that Cypress is very serious on moving this project forward. As I say, this is a resource estimate being done on the Cypress's lithium. I want to use the word deposit. Might be just a little bit too soon to say that, but we believe it is so. There is a resource here, and we're moving forward with the resource estimate. We figure this will take 4 to 6 weeks, and it will show a size of the deposit that we have. And when this gets compared, I think, in my estimation, this size that we're going to come up with will be a world-class deposit of lithium here. As I say, the project should take this resource calculation or estimate should take 4 to 6 weeks. Hopefully by the middle of March, this will be in our hands. We've already had Global Resource Engineering on the property last week. We did a 3-day site visit, looked at drill core. We've just doing other processes with the assaying, as in densities, surveying in drill hole collars for elevations. There's a lot of work that goes past the exploration stage. We're taking this project into development stage, and that's where we're headed. We're headed it there very, very quickly. I just got to add one thing else here too, Jim, and I want to emphasize that the drilling and the resource calculation that we're doing right now, this quarter, that's the main catalysts here for Cypress here in the near term, in this quarter one. We are also though continuing working on metallurgical work with 3 different laboratories. One in Colorado, one in Ontario, and one in Nevada. And we're looking for just doing all our homework in wanting to develop a process to get the lithium concentrate out of the claystone into solution, synthetic brine, and be able to process from there. And all things, especially in that world, the metallurgical world, it just takes time. And but we're over the next very short while, we'll have announcements out just, stating what type of results we're seeing from this met work. And, hopefully that the studies, which are coming along well, there'll be some very, very good news flow happening here over the next, as I say, this quarter and next.
Don, for people who are new to your company, can you tell us a bit about your background? Junior resource exploration, Jim, we've been exploring with this company, North America for nearly 25 years. We've worked everywhere from Voisey Bay to Red Lake, Ontario, with a property beside Gold Corp. Gold Corp invested in this corporation at one time, with this Cypress development at one time on a Red Lake play that we had. We've worked in many different, from gold to base metals to now lithium. And, we've been successful at different properties, other properties, we haven't. It's the old adage, if mines were easy to find, we'd all have one. So it's been a bit of a challenge, but we continue on and we continue to raise, funds to be able to explore these properties. I would suggest that for Cypress development, the best project that I've seen in 25 years come to our door is this lithium play in Nevada. Now, there's no doubt that the lithium market, the lithium demand on this planet, in this world of ours, is not going away. There's a whole new industry being created in storage of power to be able to, for all types of machinery, from cars to what have you, to be able to operate without the fossil fuels. And we believe here with the property that we have in Nevada, we have tonnage, we have grade,
and we're developing a system, a way to, again, I'll say, extract the lithium from the hard rock, from the mud, the clay stones. It's tough to call the hard rock because it's not. It's a very soft rock, but to make it amenable to turning it into a synthetic brine, and then going forward with that, producing it lithium carbonate from that.
Don, can you tell us where you're traded under what symbol?
The company's symbol, Jim, is CYP, TSX Venture. We're also Frankfurt, C1Z1, and over the counters is CYP.V. People, North America and Europe, of course, can go to any one of those sites and find whatever information is needed as fast as that. And of course, we have the website www.cypressdevelopmentcorp.com. It is up to date by the day. We keep it very, very updated. One other thing that I will mention is to be filed in the next few days is a lithium Dean Project Lithium National Instrument 43101 technical report, and it's a very, very in-depth. It's a very good reading, but it brings everybody up to date with what Cypress has done, and as I say, it's to a 43101 standard, and very, very informative. And I just believe it'll be an eye-opener for shareholders and wannabe investors.
Don, how can people get more information about Cypress?
Again, I say they can phone me at any time, 1-800-567-8181. I would suggest the easiest way is to go to the website, Cypress Development Corp, and just send an email. We get them daily, and we respond daily. Look forward to always giving out as much information as we possibly can to the public.
Don, thank you so much for the update.
Thanks, Jim. I appreciate this. I appreciate it every time we do it. Thanks very much.
I've been speaking with Don Huston, Chairman and President of CypressDevelopmentCorp.com. We were speaking on February 13th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. My guest is Brian Fowler, President of Blind Creek Resources. Welcome back to the show, Brian.
Thanks, Jim. Good to be back.
What's new at Blind Creek?
Well, there are a number of significant new developments at Blind Creek since we last spoke, Jim. And I certainly welcome the opportunity to update your listeners on the company. For those not familiar with Blind Creek, the company's a public trading company on the TSX Venture Exchange, focused on large tonnage, high-grade zinc, lead, silver property acquisitions, exploration, and development in Western Canada. Blind Creek was established in 2004 and is listed on the TSX Venture Exchange, trading under the ticker BCK. The company currently has 25.5 million shares issued and 29.4 million shares fully diluted. 43% of these shares are held by company insiders. Lately, the stock's been trading in the 30 cents to 35 cent range for a market cap in the neighborhood of $8 million, Jim. Blind Creek has 100% ownership in 2 drill-ready mid-resource stage zinc, lead, silver properties in Yukon and Northwest Territories. The company also owns a fully permitted historic high-grade gold mine in northwestern BC, which has been in the news. On January 19th, Blind Creek announced the company's intention to spin out the 100% owned Engineer Gold Mine property into Engineer Gold Mines Limited, a separate public company on a 2 shares for 1 basis through a plan of arrangement.
Now, what is Blind Creek's rationale for spinning out the Engineer Gold Mine property?
Well, Jim, as I stated, Blind Creek's a zinc, lead, silver exploration company. That being said, the first obvious question is, why did Blind Creek acquire the Engineer Gold Mine property last spring in the first place? The short answer to that is that Blind Creek already owned claims and exploration prospects adjoining the Engineer Gold Mine property and had followed through on a unique opportunity to consolidate the land package and mine for pennies on the exploration dollars previously spent. Blind Creek has since enlarged the Engineer Gold Mine property to 12,300 hectares by staking, commissioned and CDR filed a new NI 43-101 technical report and mineral resource estimate, and acquired all the necessary permits to continue exploration, mine dewatering, small-scale mining, and on-site milling. And now that we've done that, it makes good sense to spin out Engineer Gold Mine into its own gold exploration and mining company, Engineer Gold Mines Limited. The company believes that the Engineer Gold Mines project has exploration potential that should be pursued separately. The creation of Engineer Gold Mines Limited and the distribution of the Engineer distribution shares to the Blind Creek common shareholders will allow the Blind Creek shareholders to focus exclusively on the Blend and AD zinc, lead, silver properties which remain in Blind Creek after the redistribution, and the Engineer shareholders to focus on the Engineer Gold Mines project.
Brian, what are the details and timing of the Engineer Gold Mines spin-out?
The proposed spin-out will include a transfer of the Engineer Gold Mines property into Engineer Gold Mines Limited in exchange for the assumption of assumed liabilities by Engineer and Engineer Gold Mines distribution shares. Part of the agreement, Blind Creek intends to distribute the Engineer distribution shares to Blind Creek common shareholders on a pro rata basis on the reduction of the stated capital of the Blind Creek common shares. Blind Creek shareholders will be entitled to receive one Engineer distribution share for every 2 common shares of Blind Creek held by such shareholder. The effective date of the arrangement is currently planned for early in the second quarter of 2018. There will be no changes in shareholders' holdings in Blind Creek as a result of the arrangement. The arrangement is subject to TSX Venture Exchange, regulatory, and Supreme Court of British Columbia approvals, as well as approvals by not less than 2/3 of the votes cast at a special meeting of Blind Creek shareholders to be called in connection with the arrangement. Full details of the arrangement will be included in the management information circular to be sent to Blind Creek shareholders in connection with the meeting, which will include information on Blind Creek, Engineer, and the Engineer Gold Mines project and arrangement. The board of directors of Engineer is comprised of Andrew Rees, Tom Kennedy, Glenn McDonald, and myself, who also sits as president of Engineer Gold Mines Limited, while Dale Dobson has been appointed chief financial officer. This is the management team of Blind Creek. The company intends to apply for a listing of the common shares of Engineer on the TSX Venture Exchange, and any such listing will be subject to Engineer fulfilling all of the listing requirements of the exchange. The closing of the arrangement is subject to customary conditions, including the receipt of all regulatory, court, and shareholder approvals, covenants, and representations and warranties. A summary of the terms of the arrangement agreement is available on the Blind Creek profile on CDR.
Brian, does this mean that Engineer Gold Mines Limited will be trading as a separate public company at the end of April?
You got it right, Jim. Yes, Engineer Gold Mines will require a substantial amount of capital to advance the Engineer Gold Mine. In the recently received and CDR filed Engineer Gold Mine property NI 43-101 technical report and source estimate by Messrs. Darren O'Brien, PGO, Simon Dominy, FOZ, IMM.V, and Michael Redfern, PNG, a 2-phase, $6.2 million exploration and development program has been recommended for the Engineer Gold Mine property. The proposed program focuses on mineral resource expansion, metallurgical test work, and bulk sampling. Once the Engineer Gold Mines property transaction has received all the necessary shareholder, regulatory, and exchange approvals and commences trading this spring, management will endeavor to raise the required capital to advance the Engineer Gold Mine property along the lines recommended in the technical report.
Brian, switching from gold to zinc, zinc's a hot property. You have a property in the Yukon that's involved with zinc. What can you tell us about that?
Well, the fundamentals and outlook for continued high zinc prices due mainly to supply shortages and increased demand remain very good. Zinc was trading at $1.59 US a pound last I looked, and pundits have it reaching up to $1.80 per pound this year. Blind Creek's flagship property is the 100% owned Blend carbonate-hosted zinc lead silver deposit, situated 63 kilometers northeast of Keno Hill Mines. Your listeners may remember that Blend is one of the largest undeveloped zinc lead silver deposits in Western Canada, where Billiton in 1991 calculated an historic mineral resource of 19.6 million tons, averaging 3.04% zinc, 2.8% lead, and 56 grams per ton silver. This resource estimate represents 1.3 billion pounds of zinc, 1.2 billion pounds of lead, and 35.3 million ounces of silver. And I have to state, Jim, that this resource is not NI 43-101 compliant, and Blind Creek is not treating the historical estimate as current mineral resources or mineral reserves, and the historical estimate should not be relied upon. Having said that, owing to a number of factors, including advancements in the recovery of zinc oxide, Blind Creek believes there's significant potential to increase the Blend mineral resource in terms of tons and grade. This past year, the company's been actively working towards qualifying this. In our last talk in October, Jim, I mentioned that Blind Creek commissioned Frank Wright, PNG, and Moose Mountain Technical Services to conduct and incorporate preliminary metallurgical studies, geological modeling, and resource estimation in a new NI 43-101 technical report that we expect to receive later this month. This report is expected to confirm and further qualify exploration and mineral resource upsides at Blend and provide the impetus for a substantial infill and extensional diamond drill program at Blend in 2018.
Brian, what about Blind Creek's other zinc-lead project, the AB property in the Northwest Territories? What's going on there?
Blind Creek's AB property is an exciting Mississippi Valley type exploration play. We acquired just this past summer, situated just over the NWT border, 260 kilometers west of Norman Wells. We acquired the property from Eagle Plains Resources. We've increased the property size to 20,000 hectares, and it overlays a zinc-lead exploration district that has seen more than $4.5 million in previous exploration by companies like Welcome North, Arctic Red, joint venture, Rio Tinto, Inco, Cominco, Bethlehem, and Eagle Plains, during the period 1974 to 2014. The property has more than 30 known mineralized occurrences, including 2 broad coincident geological, geochemical, and IP anomalies that may represent large, varied Mississippi Valley-type mineralized systems on the property. It is these 2 large coincidental anomalies that Blind Creek wishes to drill test in 2018. The AB property has the potential to host a world-class deposit along the lines of Pine Point, Nanisivik, or Polaris. Blind Creek has initiated community relations with the local First Nation community to facilitate the exploration and drill program at AB in 2018.
Brian, can you tell us where Blind Creek is traded, under what symbols, and how can people get more information from you?
Blind Creek's trading on the Venture Exchange, TSX Venture Exchange, under the ticker BCK. Further information can be received at our website at www.blindcreekresources.com. Additionally, Jim, Blind Creek's going to be attending the upcoming Prospector Developers Association conference in Toronto in March. At the invite listeners to come. Anybody who happens to be in town to come see us will have a booth at the show for the entire 4 days. Booth number is 3304.
Brian, have fun in TO.
I will. Thanks a lot, Jim.
My guest has been Brian Fowler, president of Blind Creek Resources. We were speaking on February 14th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.